So is Bitcoin really the new digital gold? You hear it all the time, right? It's one of the biggest questions in finance, and everyone seems to have a strong opinion. But what does the actual data say? Well, we're about to dig in and find out.
To get to the bottom of this, we've actually got to rewind the clock. Let's go back to what seemed like a totally normal day in Jacksonville, Florida. But a really simple request posted on an online forum was about to become crypto legend.
A programmer, Laszlo Hanyecks, had an idea. He offered to pay 10,000 units of this obscure digital currency that almost nobody had heard of to anyone who'd just order and deliver him some dinner.
Yep, that's it. The very first real-world transaction for Bitcoin was for 2 Papa John's pizzas. Back then, those 10,000 coins were worth maybe $40.
And that's why, today, the crypto community celebrates May 22nd as Bitcoin Pizza Day. It's kind of funny, but it perfectly shows the absolutely wild journey of Bitcoin's value from the price of a late-night snack to a massive global asset. And it was that incredible, explosive rise in value that sparked this whole new narrative. As Bitcoin's price went to the moon, people started seeing it as more than just a currency. They saw it as something stable, something lasting, basically a digital version of gold.
I mean, just look at this climb. It goes from a single dollar in 2011 to knocking on the door of $100,000 just over a decade later. This kind of growth, even with all the crazy drops along the way, is what made people start comparing it to the most famous store of value in human history.
And on the surface, you can totally see why. The comparison makes a lot of sense. Both have a limited, finite supply. That's a huge part of their appeal. And neither of them pays you dividends or interest. Your profit just comes from the price going up. The parallels are pretty striking.
But here's the thing. To really test this new gold theory, we have to understand the #1 job that gold is supposed to do in an investment portfolio. We need to get clear on what a safe haven actually is.
So put simply, a safe haven is where your money goes to hide when it feels like the rest of the world is falling apart. It's the asset that's supposed to hold its value or maybe even go up when the stock market is taking a nosedive.
Here's the best way to think about it. Imagine your main portfolio, let's say the stock market, is a big ship. If that ship hits an iceberg and starts to sink, you need a life raft. But that life raft is useless if it's tied to the ship and gets pulled down right along with it. It has to float on its own.
And the way we measure if that life raft is truly independent is with a simple tool called correlation. If two things have a positive correlation, it means they move together. They're tied to each other. For a true safe haven, what you want is zero or even negative correlation to the stock market. It has to do its own thing.
Okay, so we have our tests. A real safe haven can't be correlated with the stock market. Simple enough. Now, let's put this to the test with some hard data from a study by the German Institute for Economic Research, DIW Berlin.
First, let's look at the classic safe haven, gold. Here it is, plotted against the US stock market. You don't need a PhD in stats to see what's going on here. These lines are doing their own dance. They move independently. When stocks tank, gold often just chills out or even goes up. That is exactly what you want from your life raft.
All right, now for the main event. Let's swap out gold and put Bitcoin in. And whoa, the picture changes completely. You can see the problem with the digital gold idea right away. These lines, they often move together. When stocks have a good run, Bitcoin often does too. But, and this is the crucial part, when the market falls, Bitcoin tends to fall right there with it.
And if the charts aren't enough, the numbers from the study make it crystal clear. Look at the correlation between gold and the S&P 500. It's basically zero, no relationship. But Bitcoin, it has a significant positive correlation, not just with US stocks, but with Germany's stock market too. In other words, they move together.
So, after looking at a decade's worth of data, what can we really say? What's the final verdict on Bitcoin's job as the new gold?
Well, the study's author, Alexander Kriwoluzky, doesn't really mince words. He says it plainly. When stock prices fall, the price of Bitcoin falls. And because of that, it's not a good tool if your goal is to diversify your portfolio away from stocks. So, let's just boil this all down. What's the bottom line? The data shows us that Bitcoin isn't just wildly volatile, its price is also tied to the stock market. That means it fails the big test. It doesn't act like a safe haven when you need one. For investors who are looking for that true life raft, gold still seems to be the proven choice.
And let's go back to our analogy, because this is why it really matters. An investor has to know what they're actually buying. And based on the data, Bitcoin isn't that independent life raft you can jump to in a storm.
It's acting a lot more like another risky tech stock that's already on your ship. Probably because that's how big investors are treating it, as a high-risk bet, not a safe store of value.
So the study is pretty clear. Over the last decade, Bitcoin has not been the new gold. But even the researchers point out that these relationships can change over time. So the question we're left with is this. While it may not be a safe haven today, is it possible that as Bitcoin matures, its role in the financial world could still evolve? Well, that's something only time will tell.
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.